The AI infrastructure trade is on. A lot of stocks that fall into the value chain of AI are being bid up in the market. To be fair, they also are delivering. For example, energy companies, optical networking companies, glass companies like Corning, like I said, energy providers, battery providers. So there's a lot of there are a lot of sort of ancillary trades now made in the market, and that's very typical for themes. I'm going to explain what that means, and in the meantime, the actual horses, the actual drivers of AI, the companies that are delivering AI to the consumer, are being neglected because the run has happened in certain cases, like with Nvidia. In other cases, actually, there hasn't even been much of a run, like in Meta or Microsoft. Google has had a good run, but the big run came in the last 6 months in this AI infrastructure trade, like the memory chip makers like Micron and Sandisk, Hynix, then energy providers, Vernova, or Siemens Energy, glass and cable providers, Corning and Prysmian, energy, other ancillary energy providers like Bloom Energy. So there's a lot of, Tesla actually has also benefited from that in the energy business. So there's a lot of ancillary trading going on, which is typical for infrastructure trades. I'm going to explain exactly what that means. In the meantime, again, the main investments, for example, in our case, we're betting on artificial general intelligence, which is going to be achieved through interaction with the environment, through robots on wheels and legs. And those stocks are on the back burner now. Now, long term, it is always the actual horse that makes the money. So if you want to bet on AI, then buy the companies that actually deliver AI. Don't buy ancillary companies. But in the meantime, these are the kinds of trades that Wall Street loves. This is not even a podcast. It's January 27, 2026. This is Krim Delco. For the year, we're down 3.2%. The market's up 1.2%. We're underperforming by 4.4%. So the AI infrastructure trade, let me explain a little bit what that means. So Wall Street is betting on a value chain. So there is a driver, which is AI, and a lot of people on Wall Street don't even understand exactly what that means, why it's such a big deal. Yeah, they use some of the products like ChatGPT or Google Gemini or Grok, but they don't quite understand what it takes to deliver that. They don't understand why it's such a big deal. They don't see the massive repercussions this has on business and enterprise. Maybe some do, but overall, Wall Street is just not designed for these types of disruptive innovations. But what Wall Street is incredibly good at is analyzing existing value chains and reason by analogy. That's, I would say, nobody's better than Wall Street. Anything which has been done before, anything which can be put in some sort of pattern recognition spreadsheet or algorithm, Wall Street will put billions in dollars of research into it and figure it out very quickly. And that's exactly what's happening now. So let me explain. In 2008, there was a big crash. Prior to 2008, though, there was a very big China trade going on. The China trade. China was the horse. China was driving a lot of innovation in things like minerals and commodities, and from copper and potash and corn and wheat and all kinds of commodities, because China was growing, and people weren't quite sure how to invest in this China growth story. So all these themed funds came out of the woodwork, investing in the value chain, in companies that provide machines to harvest grains, in companies that provide machines that build machines that harvest grains and everything, because the horse was China. The actual driver was China. And that's a typical trade. So you had this theme, you had the China theme, you had the China infrastructure theme, you had the China commodity theme and the commodity supply chain theme, and so on and so forth. And this is the same thing is happening now with AI. AI is a theme, And again, there are very few stocks you can actually buy with very high conviction that give you an AI exposure. One is Nvidia, the other is Tesla, and then maybe Google. And that's about it, actually. If you really look at the market, AI native stocks, AI native companies, to be honest, companies that get better by using more of their products, which is what AI native actually means. The ultimate company is, of course, Tesla, but because the product itself is getting better through its usage and it's improving itself recursively. Google has been like that for a long time. The Google search engine works like that, but of course now we're living in a whole different stratosphere of AI, and Google is catching up. So again, Google is a good proxy for these kinds of stocks. But most other companies, you're not really sure, should you buy Oracle, should you buy Microsoft, IBM, what about Salesforce? Some might even be losers in this game. But what you can buy now is the value chain. So we need energy, so you buy the energy providers. It's primarily gas turbines and transformers that they're providing. We need optical networking equipment because the data centers need to communicate within each other. So east-west and then north-south is between each other. Increasingly, we'll have clusters of data centers talking to each other. So a lot of things are going optical now. So we have glass manufacturers like Corning or Prysmian, glass cable manufacturers, and then we have the actual optical networking, the switches and things like that with Ciena and Longterm. And then we have the energy providers, like I said. Bloom Energy is an on-premise ancillary energy company that offers fuel cells. So there's all kinds of trades like that, and they're making good money. This is a good trade. I'm not by any means putting the trade down. Now, we at Orange Capital Partners are not in it. And the purpose of this podcast episode here is to give our listeners a little bit of an explanation for why we're not in it, because why are we missing out on, by the way, one important supply chain piece I forgot is the memory business, Sandisk and Micron, Hynix. These stocks are through the roof, particularly Sandisk, because their memory chips are in high demand. So even Grok, the GROQ, the chip company that was recently, let's call it, financed by Nvidia, they have invested a lot in SRAM-based technology, which is another type of memory, which is, the demand for this is related to the memory shortage. So again, there's a lot of interesting trades. You can even go further down on real estate type trades. Now, some of these have actually gone a little bit sour, like Fermi is a company that is basically building data centers and acts more like a REIT kind of company. So you provide the real estate infrastructure for data centers to be built. Now, we believe that in the long run, the companies that deliver real AI to customers will have huge value creation, and therefore we're staying invested in them. And this supply chain thing it's a tactical trade. It started in September of 2025. It might go on, it might not go on. That's very hard to say. For us, it's very difficult to gauge how far this can go. The problem with these companies is very often they're not very high quality companies. They're in very competitive markets. They have very little defensibility. So all they have is just a lot of demand and a shortage of products. And that's exactly what happened in the China trade after the Chinese growth slowed down and the Chinese economy also diversified. A lot of these stocks just ended up nowhere, including companies like Prysmian and GE, which did very well back then, also selling equipment to China. And then for a long time had basically nothing to do, if you will, until this AI boom started again. So we don't want to be invested in these types of situations where we kind of have to time it right. We're not tactical investors, I guess that's my point. Nothing wrong with that. Again, there's people out there who are very good at it. We are not in that business. We're in the long-term business. We don't want to outperform Tesla or Nvidia. We are happy with just having investments in those companies. It should be enough if you can do high 20s, low 30% annual returns. That's good enough for us. We're okay with that. And we don't want to chase more because the amount of equipment, the amount of investment you have to make, and the technologies you're using in order to be equipped to make these tactical investments it's not in our wheelhouse right now. So to summarize, the AI infrastructure trade is on. We're not in it because it's not in our wheelhouse. It's still a good trade. It's an interesting observation. It also could signal that there is definitely sort of a lack of conviction on the actual AI, and therefore this chasing the ancillary trades. It also explains why these stocks are going up. It's because you have all this money, billions and billions of dollars, that is invested in relatively small cap companies that can't absorb all that. So that's why the stocks go up so much. Versus, let's say, the large caps, they can absorb it, but again, the conviction is not there. To some extent, that's okay, like with Tesla. Tomorrow is earnings, and I think Tesla needs another maybe 3 months to start showing an inflection point. So it's kind of like the wait and see period right now. And we understand that investors maybe are reluctant to put all the eggs now in this basket. We have, because we believe that the inflection point will come relatively soon with robotaxi and unsupervised FSD, which are the two main key drivers of this year for Tesla. Thank you.